Hello everyone, welcome to the Business of Luxury. I'm Pallavi Sehgal, and this is a brief video that I wanted to do on the kind of headlines that I'm seeing on wwd.com, that is Women's Wear Daily right now. It starts with Tiffany reopening its flagship store in Tokyo, followed by Schiaparelli opening a shop inside the Neiman Marcus at Beverly Hills. But what I wanted to discuss in this video is right next to it here. It says Moody predicts a rise in retail default debt as conditions remain challenging. Let's go to this particular article and see what Moody's is saying. It says that in a sharp reversal since the benign conditions of 2021, which lasted through September 2022, defaults have since spiked, driven by dearth in debt financing, high interest rates, surging costs, declining discretionary goods spending, and supply chain challenges. Now, it says that despite our stable outlook for the retail sector, conditions remain very challenging. While retailers should benefit from the normalized freight rates, declining product costs, and less steep promotions in the second half of 2023, consumer demand for discretionary goods is under pressure. High labor expenses also hitting profitability despite decelerating overall inflation. It goes on to say that in good times, even companies with weaker credit scores can refinance. They have to pay more and limit their financial flexibility. But in the current financing climate that has shifted rapidly over the past 1 year, as the Federal Reserve has racketed up the benchmark interest rates by 5% to fight inflation. Weaker, highly leveraged companies continue to have a tough time accessing capital in the market where investors remain risk averse. This will be increasingly problematic for companies at a lower end of rating scale. Out of 127 retail and apparel companies, we currently rate 16 at CAA1 and below, a level that indicates high likelihood of default. About 60% of the US retail and apparel companies rated B2 and below have only floating rate debt and therefore fully exposed to rising rates. Moody's added that our analysis also indicates that most have no interest rate protections in place. Generally, the smaller the company, the more likely it is to rely on floating rate debt, making it more vulnerable to increased costs. Given this and the kind of news that we have been seeing over the last couple of weeks, wherein we have very good outlook for the luxury sector in general, but at the same time, for the retail sector, we are seeing that Moody's is predicting a rise in the retail debt defaults. So are we going to see something very similar to what we saw in the pandemic, wherein we had major retailers like Barney's declare bankruptcy and go under, but at the same time, we had bumper results from almost all the luxury conglomerates and even the smaller luxury contemporary brands? Now, that is something that we'll have to watch for. So keep tuned in as we bring you analysis on this. Thank you. Thanks for watching.